Imagine a company where brilliant ideas, projects that could genuinely reshape its future, are just left on the drawing board. Not because they're bad ideas, not at all, but maybe because of the very numbers used internally to measure success.
Right.
Today, we're doing a deep dive, really uncovering these hidden incentives that can make companies, even the biggest ones, sort of inadvertently shoot themselves in the foot.
Yeah, and it's definitely not just about accounting, is it? It goes much deeper.
Absolutely. This isn't just bean counting. It's about deeply understanding how large organizations really tick and why the choice of internal metrics can lead to some surprising, sometimes really counterintuitive results.
And you're spot on. These internal metrics, they're like the invisible hand guiding major investment decisions. They shape how resources get allocated, and ultimately, they determine a company's long-term trajectory. It really is all about the behavioral incentives these numbers create.
Okay, so if we want to truly understand how performance is judged within, say, a big, sprawling company, we have to start with a really crucial distinction.
What's that?
Is the head office evaluating the division itself, or are they evaluating the manager running that division? It sounds simple, maybe, but separating these two is absolutely key.
Exactly. And the foundational idea here, the concept we need to grasp, is controllability.
Controllability.
Basically, a manager should only be assessed on things they can directly influence and control. Makes sense, right?
Yeah, totally.
But the division, well, that's assessed on its overall performance, regardless of whether the divisional manager has a say in every single element. It's fundamentally about attributing responsibility fairly.
That makes perfect sense. So, okay, if we're separating the manager from the division, how do we even begin to slice up the financial picture? Are there different kinds of profit we need to think about to make sense of this?
Absolutely. Yeah, this distinction naturally leads us to think about profit in, let's say, 3 distinct layers. Each serves a different purpose.
Okay, layer 1.
The first is controllable profit. This is the revenue generated by the division minus only those costs the divisional manager has direct control over.
Like what? Day-to-day stuff.
Exactly. Things like variable costs tied to production, maybe some local fixed costs within their direct budget. This figure is all about assessing how well the manager is doing their job.
Got it. So that's for the manager. What's the next layer down?
Next up, we have traceable profit. This starts with that controllable profit we just talked about.
Right.
And then subtracts additional costs that are directly linked or traceable to that specific division. But crucially, the manager doesn't control them.
Ah, okay. Like what kind of costs are we talking about there?
Well, think about maybe a major national marketing campaign for one of the division's products. It might be initiated and budgeted entirely by head office.
Okay, I see. The division benefits, but the manager didn't decide on it.
Precisely. Or perhaps significant legal fees tied specifically to the division's activities, but handled centrally. These costs are clearly for that division, but the manager didn't sign off on the spending.
So traceable profit gives you a clearer picture of the division's performance.
Yeah, the division's internal performance kind of separate from the manager's immediate decisions.
Okay, controllable, traceable, and then the final layer.
That's divisional profit. This takes the traceable profit and subtracts centrally incurred allocated head office costs. These are the shared overheads, think central HR, IT support, the finance department, things that serve multiple divisions.
Basically, the cost of being part of the bigger corporate family.
You got it. That's a good way to put it.
So why bother with this third layer then? What does divisional profit tell us that traceable profit doesn't?
Well, divisional profit is important because it paints a picture of what that division would likely have to incur if it were, say, an independent company, standing completely on its own feet.
Okay.
So this makes it the most suitable figure for comparing the division's performance against external competitors. It gives you a truer sense of its standalone viability out there in the marketplace.
Without it, you'd be sort of overstating its profitability compared to a real independent business.
Exactly. They wouldn't get those central services for free.
Okay, let's try and put some numbers to this just to see how it shifts to perspective. Say a division starts with, revenue of $529 million.
Okay, healthy start.
Right. Then you take out, say, $286 million in variable costs and $137 million in fixed costs that the manager controls. That leaves, what, $106 million? That's the controllable profit.
$106 million.
Yeah.
For the manager's performance.
Then you subtract those traceable costs, maybe a $28 million marketing campaign agreed by head office. Now we're down to $78 million. That's the traceable profit.
Okay. Quite a drop already.
Yeah. And finally, you allocate, say, $43 million in head office costs. Suddenly, the divisional profit is just $35 million.
From over $500 million in revenue down to $35 million in divisional profit.
It really shows how the picture changes depending on what you're trying to measure: the manager, the division internally, or the division as a potential standalone entity.
It absolutely does. And while this tiered structure makes, theoretical sense, applying this concept of controllability in practice, well, it can be incredibly challenging.
How so?
It's rarely black and white. For instance, a manager might not control global raw material prices, sure, but maybe they can influence things by sourcing cheaper alternatives or negotiating better payment terms.
Ah, okay. So where do you draw the line?
Exactly. How do you define what's truly controllable? And another tricky one. If a big central marketing campaign generates a huge chunk of revenue, but the manager had zero say in it, how do you fairly attribute that extra revenue when looking at their controllable profit?
That's a massive challenge. So, an otherwise brilliant manager could see their performance numbers dip because of something completely outside their influence.
It happens, yeah.
How do companies even begin to deal with that without just, making excuses for everyone?
Well, one common approach is for the company to very explicitly define and communicate which budget lines are considered controllable for a manager's performance assessment and which aren't.
So just spell it out beforehand.
Right. It removes ambiguity, or at least reduces it.
Yeah.
But that core issue of defining control in the real world, that remains complex.
Okay. So with those different layers of profit, now clear, controllable, traceable, divisional, the next logical question is, how do companies actually use these figures to assess performance day to day or year to year?
Right. And that's where two big players, two very common metrics come into the picture. Return on investment, usually called ROI.
Yep, heard that one.
And residual income, or RI.
RI. Okay, tell me about ROI first.
ROI is conceptually pretty straightforward. It measures the division's operating profit as a percentage of the assets employed in that division.
Profit divided by assets, essentially.
Basically, yes.
Yeah.
And you typically use traceable profit over traceable investment if you're looking at the division, or controllable profit over controllable investment if you're assessing the manager.
Keeping that distinction going.
Exactly. And the key insight, the takeaway for ROI, is that for a division to be genuinely profitable in the long run, its ROI needs to be higher than the company's cost of capital.
Makes sense. You need to earn more than the money costs you. And what about this other one? Residual income, RI.
Okay, RI takes a slightly different angle. It calculates the division's income and then subtracts an imputed cost for the capital it uses.
Imputed cost, like a made-up charge.
Well, calculated, not made up. Think of it as charging the division a kind of rent for the money, the capital, that's tied up in its assets, its buildings, machinery, inventory, all that.
Okay, so how do you calculate that rent?
Usually it's based on the company's WACC. That's the weighted average cost of capital.
Right, WACC. Sort of the average rate the company pays to borrow money or get investment from shareholders.
Precisely. So the RI formula is basically traceable or controllable profit minus that imputed interest charge on the division's investment base.
And what does the result tell you?
If you get a positive RI number, a positive dollar amount, it means your division is generating a return greater than the company's target cost of capital. It's adding value above the hurdle rate.
Okay. And sometimes you hear about ROCE too, especially for external comparisons. Is that related?
Yes, ROCE, return on capital employed. It's a similar measure, often used by external analysts to assess a company's overall profitability and how efficiently it uses its capital. The calculation might differ slightly depending on definitions, but it serves a similar purpose, showing how well a company generates profit from its asset base.
Gotcha. Okay. ROI. They sound like useful tools. But here's where, as you said earlier, the real-world consequences can become clear and often quite paradoxical. Let's look at a scenario. Picture two divisions, Division A and Division B.
Okay.
Now, Division B, maybe in the second half of the year, decides to invest in its future. They launch a new product.
Sounds positive.
You'd think so. They pour, say, $50 million into new machinery needed for this product, and they also incur another $14 million, let's say, on a major marketing campaign for the launch, maybe run by head office.
It's a significant investment. $50 million in capital, $13 million in traceable costs for the marketing.
Exactly. It sounds like a smart, forward-thinking move, right? Building for the future.
Absolutely. You'd think that would be encouraged and rewarded.
Yeah.
But let's look at the numbers, perhaps.
Let's do it. So for Division A, let's say their ROI and RI were pretty stable year over year. ROI may be hovering around 15.5 to 15.9%.
Okay, you say.
And then their RI may be around $11.0 to $11.5 million. Consistent.
All right. And Division B, after their big product launch.
Well, this is where it gets wild. Their ROI, which was a healthy 18.7% the previous year, it plummeted down to 13.7%.
Ouch. Below Division A now.
Way below. And their RI dropped from $20.0 million the year before down to just $10.5 million.
Wow. So less than Division A's RI as well.
Exactly. What's striking here, what's so counterintuitive, is that both these key measures, ROI and RI, suggest Division D's performance significantly deteriorated.
Yeah, it looks like a failure on paper. Worse than the steady Division A.
Despite doing something strategically beneficial for the long term, this raises a really important question. What on earth happened?
Well, the crucial insight here, and this happens all the time, is that this apparent deterioration is a direct result of that new investment and the marketing spend.
Oh.
Think about it. The $50 million capital investment drastically increased the capital employed part of the ROI calculation, the denominator, and it increased the base on which the imputed interest for RI is calculated.
Okay, that pushes ROI down and increases the charge for RI.
Right. And that $14 million marketing campaign, that increased their traceable costs, directly hitting the profit figure used in both calculations.
And the benefits haven't kicked in yet.
Critically, yes. The product was launched mid-year, maybe even later. So the revenue benefits, the upside from the new product, haven't fully materialized yet to offset these big upfront hits to the metrics, even though everyone expects it to generate significant profit in the following years.
So Division B looks like a disaster on paper this year, but they were actually making a smart, long-term strategic move. That's a huge disconnect.
It absolutely is. And it perfectly illustrates a major, major problem in performance measurement, short-termism.
Explain that.
Managers, knowing they're being judged on these yearly or even quarterly ROI and RI figures, might actively avoid making beneficial long-term investments.
Like buying new machinery or funding R&D.
Precisely. Or even launching substantial marketing campaigns. Because these necessary expenditures negatively impact their short-term performance metrics, the numbers are judged on now.
Even if it hurts the company down the line.
Exactly. This can lead to what we call dysfunctional decision-making. The manager's actions are perfectly rational for their immediate performance targets for hitting their bonus,
Right.
but they actually undermine the overall goals and the long-term health of the company as a whole. It's this silent battle, this tension happening inside corporations constantly.
Do companies try to fix this? Like, can you adjust the numbers somehow?
They do try. For instance, one common adjustment is to use an average capital employed figure for Division B, rather than just the end-of-year total, which includes the full $50 meter whack.
How does that help?
Well, averaging smooths out the impact of the mid-year investment. If you do that for Division B, their RI might actually look better. Maybe it jumps to $13.3 million, which would actually be better than Division A's $11.5 meters.
Okay, so that helps RI. What about ROI?
Even with averaging, Division B's ROI might only improve to, say, 15.1%, still lower than Division A's 15.9%.
So even with adjustments, that core problem, that disincentive for long-term investment, it often persists, doesn't it? The numbers aren't always telling the whole true story.
They often aren't. And this example also flags up a broader issue with performance measurement generally, the problem of comparability. Performance comparisons, like judging Division B against Division A, are most useful when the things you're comparing are genuinely similar, like apples to apples.
But they often aren't.
Right. If one division just had a massive capital injection like B did while A didn't, or if one division's assets are brand new and another's are really old and mostly depreciated,
Right.
comparing their ROIs or IRIs can be seriously misleading.
How does asset age affect it?
Well, think about it. If assets are valued at net book value cost minus accumulated depreciation, then as assets get older, their book value shrinks.
Okay.
That means the capital employed denominator in the ROI calculation gets smaller over time. So even if profit stays the same, ROI actually increases as assets get older.
Wait, so you look better if you keep old, potentially inefficient machines?
Perversely, yes. It can actively encourage managers to hold on to outdated assets just to make their short-term ROI and RI numbers look good. Another form of dysfunctional decision-making.
Wow. Okay, so given these issues, especially that painful paradox with Division B looking bad for doing something good, which measure is actually better? ROI or RI? Or is there even a better one?
That's the million-dollar question, isn't it?
It brings us back to that crucial concept you mentioned, goal congruence.
Exactly. Aligning the manager's personal incentives and decisions with the overall company's goals. Let's test ROI and RI against that idea.
Okay, how?
Let's consider a hypothetical. Imagine Division A, remember their current ROI is strong, say 15.9%.
Right.
Now, suppose they get an opportunity to invest in a new project, a good one, expected to return 12%.
Okay, 12% return.
And let's say the company's WACCC, its cost of capital hurdle rate is 10%.
So 12% is higher than 10%. From the company's view, this project adds value, right? They should do it.
Absolutely.
Yeah.
Any project returning more than the cost of capital should, in theory, be undertaken because it increases overall company value. Now, what happens if Division A's manager is evaluated primarily using ROI?
Uh-oh. Their current ROI is 15.9%. The new project only returns 12%. So, taking on that 12% project would actually drag down their overall divisional ROI from 15.9% towards 12%.
Exactly. So what's the manager likely to do?
They're likely to reject this perfectly good value-adding project.
That's it. A classic example of ROI leading to dysfunctional decision-making. A project that's good for the company gets ignored because it makes the manager's personal metric look slightly worse.
Okay, but what if that same manager is evaluated using RI, residual income?
Now it's different. The project's expected return is 12%. The cost of capital charge is 10%.
So the return is higher than the charge.
Meaning it will generate a positive residual income. It adds dollars to the bottom line after covering the capital cost. So the manager evaluated on RI.
They will invest in the project.
Correct. And this is precisely how RI promotes goal congruence. It encourages managers to invest in any project that earns more than the cost of capital, adding value to the company, regardless of what their division's current average ROI happens to be.
What's fascinating here is how RI seems to align beautifully with another key financial concept, net present value, or NPV.
Yes, exactly. NPV is widely considered the gold standard for evaluating investment decisions from a purely financial perspective.
Remind us what NPV is again.
Think of it as calculating the true value, in today's money, of all the future cash flows a project is expected to generate after accounting for the time value of money and risk. If the NPV is positive, the project is expected to add value to the company.
And RI leads to the same accept decision as NPV in our example.
Generally, yes. Projects with positive NPV should also generate positive RI, assuming the cost of capital is used correctly. RI also has another advantage: flexibility.
How so?
You can, in theory, apply different costs of capital, different imputed interest rates for different divisions, or even different types of investments to reflect varying levels of risk. A riskier division could face a higher capital charge.
That sounds incredibly powerful then. Better goal congruence, aligns with NPV, flexible. But does RI have any drawbacks? It sounds almost too good to be true compared to ROI.
It does have drawbacks. First, as we touched on, there can be real difficulty in accurately estimating the cost of capital, that WACC figure.
Getting the balance right between debt and equity costs.
Yeah, that's part of it. And in practice, investment centers are sometimes only charged for the debt portion of the corporate capital they use, which significantly understates the true full cost of capital, including the cost of equity.
Okay, so getting the charge rate is tricky. Anything else?
The other main issue is that RI results in an absolute value, a dollar figure, like $10.5 million in our example.
Right, not a percentage like ROI. Why is that a problem?
It makes it much harder to compare performance directly between divisions of vastly different sizes. Is a $10 million RI from a huge division better or worse than a $5 million RI from a tiny division? It's hard to tell without context. ROI's percentage makes that size comparison easier.
Okay, so let's recap quickly. ROI, easy percentage comparison, good for relative performance, but can encourage short-term thinking and rejecting good projects. RI, better for goal congruence, aligns with value creation, NPV, encourages right investments, but harder to estimate the capital charge accurately, and the absolute dollar figure makes comparing different sized divisions difficult.
You've got it. That's the trade-off.
So if both have these significant pros and cons, what's the next evolution? How do companies try to find a measure that gets the best of both worlds, or at least tackles these problems more directly?
Well, that leads us into another important measure, developed specifically to address these issues: economic value added, often known as EVATM.
EVATM, I've heard of that. It's trademarked, right?
Yes, it's a specific methodology and trademark developed by the consulting firm Stern, Stewart & Co. But the underlying concept is similar in spirit to residual income.
How so?
It also deducts a finance charge from profits to identify the true economic value being added or destroyed. The basic calculation is NOTAT net operating profit after tax minus a cost of capital charge, which is usually WACC multiplied by the division's assets or capital employed. So profit minus WACC x capital looks a lot like RI, right?
It does. NOPAT instead of traceable profit, but the structure is similar. So what's the big deal? What's the key difference? The magic sauce of EVA?
The magic sauce, as you put it, lies in the significant adjustments EVA makes to both reported financial profits and the capital employed figure. The goal is to reflect true economic value, not just accounting profit according to standard rules.
Adjustments, like what kind of adjustment?
Well, for instance, EVA typically capitalizes many value-building expenditures that companies normally just expense immediately in their accounts.
Capitalizes means treating them like assets.
Exactly. Spreading their cost over time instead of taking the full hit in one year. Think about things like research and development spending, major marketing campaigns, even significant staff training programs.
So remember Division B's big $14 million marketing campaign that tanked its RI and ROI?
Under EVA, that likely wouldn't have been treated as a simple $14 million expense in that year. It would probably be capitalized and then amortized or spread out over the period it's expected to generate benefits.
That would smooth out the hit considerably.
Absolutely. It directly reduces the immediate negative impact on short-term performance metrics. The idea is to encourage managers to make those necessary long-term investments without fearing immediate punishment in their performance numbers.
So it's explicitly designed to combat that short-termism we saw was a major flaw in ROI and sometimes RI.
Precisely. EVA aims to align manager decisions much more closely with maximizing long-term shareholder wealth. It tries to get managers thinking like owners.
Are there other key adjustments EVA makes?
Yes, quite a few potentially. For example, EVA often uses gross asset values, sometimes based on replacement cost, rather than the net book value used in traditional accounting.
So getting rid of that weird incentive to keep old assets because their net book value is low.
Exactly. And it might use economic depreciation, which reflects the actual decline in an asset's value-generating capacity, rather than accounting depreciation rules. It also often eliminates non-cash accounting provisions, like provisions for doubtful debts, trying to get closer to actual cash generation.
Okay, it sounds quite sophisticated, really trying to iron out the kinks in traditional measures and tackle that short-termism head-on. But realistically, is EVA truly a magic bullet? Does it solve everything, or does it come with its own set of complications for companies trying to actually use it?
Definitely not a magic bullet. It has its own challenges. Firstly, just like residual income, EVA results in an absolute measure, a dollar figure of value added.
Right, so still hard to compare a massive division's EVA with a tiny one's.
Exactly. That limitation remains. And probably the biggest practical hurdle is the sheer complexity and number of potential adjustments required.
It sounds like a lot of extra work for the finance team.
It can be. Calculating NOPAT accurately according to EVA principles, adjusting the capital base, it can be quite time-consuming and requires significant expertise and dedicated resources to implement and maintain properly. You need a robust system to track all those adjustments consistently.
So when we step back and look at all these different metrics we've discussed, ROI, RI, EVA, it feels like, regardless of which specific financial measure a company chooses, certain common problems, these universal hurdles, seem to persist, don't they?
That's a really crucial point to take away, yes. Even with sophisticated measures like EVA, some fundamental challenges remain inherent in trying to capture complex performance in a single number or set of numbers.
What are some of those big overarching issues that cut across all these methods?
Well, one we've touched on is comparability issues stemming from asset valuations.
Right, the old assets versus new assets problem or different valuation bases.
Exactly. Imagine trying to compare two hotel divisions within a group. One holds its prime city center properties at historical cost from, say, 30 years ago. The other division just built new hotels or recently revalued its portfolio upwards to current market value.
Their asset bases would be wildly different.
Hugely different. The division with the revalued properties will have a much higher capital base, making its ROI or RI appear artificially lower, even if its day-to-day operations are fantastic.
And that feeds back into the incentive to maybe not revalue assets or to hang on to older ones?
It certainly can, because older assets with lower net book value can make a division's performance look artificially better on these metrics over time as depreciation reduces the capital base.
Okay. Comparability is a big one. What else?
Then there's that ever-present shadow of short-termism that we keep coming back to.
It seems inescapable.
Financial performance measures, almost by their nature, tend to focus on short periods, a quarter, maybe a year. This inherently pushes managers, consciously or subconsciously, to prioritize immediate results, things that look good now.
Even if it means potentially sacrificing long-term value-generating projects that might have a negative impact in the short run because of, say, upfront capital spending or initial losses.
That's the danger. It's a structural bias toward the short term in many financial reporting systems.
Any other major cross-cutting challenges?
And finally, just the simple fact of differences in accounting policies. Even within the same group, or certainly between different companies, the specific accounting treatments chosen for things like valuing inventory, recognizing revenue, capitalizing development costs, or handling intangible assets can vary.
Even if they're all following the general accounting standards.
Yes, there's often still room for judgment and different choices within the standards. These differences can make true apples-to-apples comparisons between different divisions or between a division and an external competitor incredibly difficult. It's like trying to compare, I don't know, two runners when one's running uphill on sand and the other's running downhill on a track. The raw times don't tell the whole story.
What a deep dive this has really been. We started by exploring that really fundamental distinction, didn't we, between evaluating a division's overall performance versus the manager's controllable performance.
Which underpins everything else, really.
Absolutely. Then we navigated through the details, the nuances, and importantly, the pitfalls of return on investment, ROI, and residual income, RI. We saw how they can, kind of surprisingly, lead to these counterproductive, dysfunctional decisions, even when managers might think they're doing the right thing for their numbers.
That Division B example really highlights it.
It really does. And then we explored economic value added, EVA, as a kind of evolution, specifically designed to tackle some of those very issues, especially short-termism.
Though not without its own complexities.
Right. And ultimately, we landed on these common challenges that seem to persist across all these financial metrics issues around comparability, that deeply ingrained problem of short-term focus and differences in accounting treatments.
It truly reinforces the core message, I think. Choosing the right performance measure or combination of measures, it isn't just some technical exercise for the accountants tucked away in a back room.
No, it has real consequences.
Yeah. It profoundly impacts manager behavior. It shapes major investment decisions, and ultimately, it affects the company's ability to actually achieve its long-term strategic goals. Getting it right, or at least understanding the limitations, is critical. As they say, knowledge is most valuable when it's understood and actually applied.
So here's a thought to leave you with. The next time you hear about a company's quarterly results, or maybe read about a major investment decision they've made or perhaps decided not to make, you might ask yourself, what internal metrics are they likely using to judge their divisions and managers? And what unseen incentives, what potential behaviors might those measures be creating behind the scenes? Could a seemingly poor quarterly result like Division B's actually be a sign of smart long-term thinking? Or could fantastic short-term results be masking an avoidance of necessary investment? How would you measure success if you were in charge?
That's a great question to ponder.
It's a fascinating lens to apply, not just to the business world, but perhaps even to how we measure progress in our own fields or lives.